Hey everybody, this is John Murphy with CSSI. I'm here to talk about cost segregation for commercial real estate brokers. I get a lot of requests, particularly from CRE brokers, to give a breakdown of how cost segregation works. You guys don't need to be the experts. I will just tell you this is a tremendous opportunity for you to be able to help your clients. You might be able to get some more deals out of this, et cetera. But let's get through this here. Again, my name is John Murphy. I'm with CSSI. I work all over the country. Happy to be a partner with you in your business. Feel free to just reach out to me on LinkedIn or give me a call, send me an email. Happy to talk with you about it offline. But here's a nice overview for you for the commercial real estate brokers and what the opportunity is for you. This is a chance for you to introduce your clients, help them save money. It's easy money for you guys, really. Seriously, with referral fees. I know it's not going to make or break your year, but it's nice to get paid a little extra money for this. The tax savings that might be generated for the owner might lead to another deal that you can get done with them. It provides value added. It's great consulting that you're providing the client before your competition does. I think it builds customer loyalty and it allows you to differentiate yourself in the marketplace. So let's get into this. Commercial property, depreciation. When people buy buildings, they get to depreciate it. It's a tax savings for them. They depreciate it over 39 years if it's commercial property. If it's multifamily residential investing, it's 27 and a half years. But we're going to talk about commercial property mostly here. So you divide 1 into 39, they get 2.5% depreciation each year for their building. That's what they get. That's the tax deduction that they get to take. So if it's $1 million basis on the building, that's $25,000 per year in depreciation expense that they would get. So how often can they get this done? Well, you can do it basically once per building ownership, unless there's some additions or remodeling that goes on. And then also every time a building trades, a cost segregation study can be done for the new owner. If the owner is doing renovations that are, say, about $100,000 or more, that's something that we should take a look at if they're done in a different year than the year that they put it in the tax. In the service, if you will. So, for example, if they bought the building in 2022 and they did $100,000, $200,000, $300,000, $500,000 renovation in 2023, they should look at doing a study on that renovation. Any building additions also should be studied. So let's just give you a quick example on a commercial property. Let's say this was put into service on July 1st, 2023, so halfway through the year. Purchase price was $1.2 million. Let's put a land value of $200,000 on this property, so they have a cost basis of $1 million for the property. If they're at a 32% tax rate, in 2023, as you know, they get 80% bonus depreciation, so that's everything that's under a 20-year class life. They can take 80% of that in year one. So straight line depreciation for this owner, they would get $1 million cost times 0.025, 2.5% for 6 months. They're going to get $12,500 in depreciation. If they do accelerated depreciation, let's just say we're going to identify about 20% of that building, just to give some round numbers here. That could be accelerated. Multiply that by 80%, you end up with $160,000 depreciation, or almost 12 times more depreciation that they could take in 2023 because they did a cost segregation study. So what happens when you sell? I get this question a lot. Okay, there's recapture tax. Absolutely something you need to be thinking about. I'm not here to give you tax advice. You shouldn't be giving tax advice either. Let them talk. Let the owners talk with their own tax advisors. When you do regular depreciation straight line, you're going to pay back recapture tax at a 25% federal income tax rate as of today, unless Congress changes that. When you accelerate depreciation, you pay that back at your earned income rate. So that might be 24%. It might be 32, 34, 35, 37. So you might end up paying a higher tax back on recapture tax. There are ways to minimize it. Certainly 1031s are very prominent, and people will push those basically delay paying taxes on that. They push it in the 1031 exchange. You could also look at putting a diminished value on your 5 and 15-year class life property. I won't get into that, but at some point we could chat about that further. That is a way to be able to reduce your recapture tax. Basically put a lower value on that 5 and 15-year property because it's used. So what's the financial impact when you do cost segregation? For just ballpark, we just like to say, hey, for every $1 million in cost basis, the owner's going to see between about $30,000 and $70,000 in income tax savings. It's a one-time savings. The reason that is such a broad range, it depends on the type of building, how much can be accelerated. It depends on the owner's tax rate and if they can take advantage of this. The money that is saved, okay, basically it just means the IRS is not going to send the owner a check. They don't have to send a check to the IRS for this amount is what happens, but the money can be used for anything. They can hire new employees. They can renovate buildings. They can buy a car, buy a truck, buy a boat. They could go buy another building. They can just keep it in their bank account. It's their money. They can use it for anything that they want to do it, that they want to use it for, and it is a one-time tax deduction on their income tax, basically, with this bonus depreciation. Commercial brokers, don't be cost segregation experts. Just know enough about it. If you're representing an owner who's buying a property, this definitely should be part of the due diligence that you provide for them. And you can, call me, email me, have our team run an estimate for you before you guys close on the property. You should take that into consideration when you're representing a buyer of any property. Get a cost segregation estimate done so they know that what they could save on their taxes. Who's good candidates for cost segregation? Well, it's really any commercial property. Any commercial property that's $200,000 in cost basis or higher could be studied for tax savings. Any new purchases, any buildings that have been held for years, particularly if they've had improvements, they should look at them. If they've not done cost segregation, what we tell those owners, just send us the depreciation schedule. We'll take a look at it, and we'll let you know if we think that there's more that can be done and more tax savings for you. If you're doing any additions or any renovations to buildings, those should be studied as well, or at least considered. Partial asset disposition, I see this is missed almost all the time. So if you have an owner that's doing renovations, say $100,000 or more in an improvement to their building, this is for buildings that have been in service already for one tax year, they can do what's called partial asset disposition. Basically, it is a use it or lose it tax savings. It's a 2-for-1 deal. Basically, they get a deduction in the year in which they do the work. In that tax year, they can take a deduction that year, and then it also gets removed off of their taxes, or off of their basis, if you will, so they don't have to pay recapture tax eventually when they go to sell the property. And the reason is we do the calculations of what's gotten thrown out of the building that's currently on their depreciation schedule. It's part of their existing basis to that building, but they renovated it, they threw it in the dumpster. Okay, it's no longer part of the building. We do all the calculations for that, and the owner gets a nice tax deduction. What we typically see, it's probably going to be about 15 to 20%, give or take, of what the improvement costs were. So if it's $1 million improvement, they might get $150,000 to $200,000 tax deduction. That is significant and not something that you want to ignore. But I will just tell you, most of the owners do miss this tax deduction. So catch-up depreciation. We get asked, hey, I've held the building for 10 years. Can I still do cost segregation? Yes, you absolutely can. Again, just let us look at it. We'll take a look at the depreciation schedule. We'll let you know if we think we can identify more property that could be beneficial to you to take as a depreciation this year for your taxes. And we'll send you the information on that and give you specific information about what that might look like. So when you do that, you do need to file a change of accounting form. It's a 3115 form. We handle that. A lot of the CPAs, don't really want to mess with that. They don't do a ton of them all the time, certainly not for cost segregation. We do them all the time. So we can take care of that for the owners for a fee. It's very reasonable. And then the owner's CPA or tax advisor would sign off on that. So the taxes do not need to be amended. Just want to make sure you understand that. How to bring cost segregation up with a building owner. For commercial real estate brokers, this is such a no-brainer in my opinion. It's a great way to connect with owners. You can add, value add. You might be able to build greater loyalty if you introduce one of your clients or prospects to cost segregation, and they save $30,000, $50,000, $100,000 in tax savings of which they were not aware of before. I just think that that's going to build some loyalty for you in the future if they want to go to buy or sell another piece of property, that they're going to think of you. So just real quickly, you're talking with an owner, communicating with them. Hey, you just ask them, hey, while I have you on the phone, have you ever done cost segregation for your building for tax savings? Simple as that. It's just a quick little question. If they come across as like, hey, I have no idea what you're talking about, okay, it's highly likely they have not done cost segregation. They might say, hey, you know what, I've been thinking about that, but just haven't done that yet. Do you have a good source? Do you have a good source for that? So then you can, make the connection, and we can reach out, talk to them, run the numbers, and then we send it off to them. We always tell them to run it past their tax advisor, make sure that they can take advantage of it. We're not going to give them tax advice, but if the tax advisor says, yeah, hey, this looks great, we can do the study, that's fantastic. Now you've just helped the owner, okay? You're going to get paid a referral on that. The owner's going to save a lot of money on taxes, And everybody wins in that situation. So who can use cost segregation? Full-time real estate professionals, okay? So one thing I'll just say for commercial real estate brokers, and again, you got to consult with your own tax advisors, but in the tax law, if you're considered a full-time real estate professional, of which most of you probably are, you can use the depreciation generated from the buildings that you might own or that you have investments in to offset your income. So if you're making great income as a commercial broker, 2, 3, 4, 500,000, $1 million a year, whatever it is, you're having a great year, you can use that depreciation to help lower your own tax liability. Also can work for investors, active and passive, W-2 earners. It's a little bit different. You know, the way the government looks at that is if you're a W-2 earner and you're not a full-time real estate professional, you're not an active real estate person, you're going to have a separate, kind of two flows of income. You're going to have your passive, and then you're going to have your active. And if you own a bunch of real estate investments, but let's say you're a doctor, okay, we've got your earned income. That's one stream of income. Your passive income or real estate income is another stream of income. And if you do accelerated depreciation through cost segregation, that's going to help lower your tax liability from your passive income. Okay, so it still may help. It may help your overall tax liability if you're making money off of your real estate investments, and might end up putting you into a lower tax bracket. Again, all those things should be looked at. We just tell people, hey, just send us your buildings. We'll run the numbers for you. We'll give you a projection of what we think you're going to get out of it. You talk with your tax advisor. If it works, great. If it doesn't work, no problem. Okay. Owner-operators. This might be doctors, dentists, people running distribution companies. Maybe they got a small manufacturing operation. Whatever it is, the self-rentals, those are fantastic. They're going to want to look at grouping their property if they qualify for grouping, to be able to do that so they can use the depreciation from their building to offset their operating business income. That's a terrific strategy. 1031 exchanges, we rely on the CPAs to give us the depreciable value, depreciable basis that remains in the new building. And oftentimes there is depreciation that's still there that could be studied. And I'll have an example here in a second as we go through this here on a Starbucks. What can cost segregation offset in terms of income? Kind of went through that just a second ago. If you're a passive investor, the cost segregation is going to offset your passive investment income. Okay, if you're a W-2 earner, it's not going to offset your W-2 income. That's just not going to work that way. However, if you're a husband and wife and one of them's a full-time real estate professional, again, consult with your tax advisor. But that is a great strategy there where you can use depreciation to offset your household income potentially. So not good prospects for cost segregation. Okay, if someone buys a property through a 1031 exchange, they purchase the entire property using 1031 money. There's no fresh cash. There's no fresh debt that's put on the building. That's not going to be a good candidate for this. If an owner intends to flip a property within 18 months, generally we say that's probably not a great candidate. Typically, we like to recommend that people hold for at least 2 to 3 years. We know commercial property owners often will hold for 5 to 7 to 10 years, and they're great candidates for cost segregation. If the building is not particularly expensive, if it's less than $200,000, probably not going to be a great candidate because our fee is going to cost about $2,000 anyway, minimum. To do that study, so we may not generate a lot of depreciation for that owner, and then of course not for profits. They're not paying taxes, so we can't. It doesn't make sense for us to do cost segregation. They can't take advantage of it. If you have listings or active deals that you're working on, have us run the estimates for you. You could use this as a marketing piece if you want. It's again more education for the potential buyers. One of the things that you can do, it doesn't really matter who pays for the study. You might be trying to negotiate a deal, and maybe your clients are arguing over some big repairs, or maybe the parking lot's got to be redone or something like that. And you go, well, hey, you know what? Maybe Mr. Seller will pay for the cost segregation study, and the buyer can get the tax advantage of that. Maybe the tax advantage is $50,000, and that might cover the cost for repairs or improvements to the parking lot or whatever it is that's in dispute that needs to be taken care of. So anyway, keep that in mind. You can use that in a lot of different ways, but it's just a piece of information. It's due diligence that you really should have, whether you're the listing broker or you're representing the buyer on the buy side. So what kinds of properties does this work on? I mean, literally everything. We'll get stuff all the time. People say, hey, will this building work? Will this building work? Will this building work? They all work, you guys. They all work, okay? As long as the basis is more than $200,000, If the owner's profitable, if they're making money on it, if they can take advantage of this depreciation, the buildings are going to work. They work every time. We've done about 45,000 of these. It has worked every single time, okay, to the benefit of the owner. So whether it's ground up new construction, whether it's resales, if it's existing property that you currently own, if you're doing renovations, properties where you plan to hold them for 2 or more years, properties that you've held for years, properties that have been in service that you've had that you're going to bulldoze and redevelop the property. Those should be studied because you can take the depreciation on that 5 and 15-year class life, not have to pay recapture tax. You bulldoze the building, you're going to get the tax deduction, but you just saved yourself a bunch of money by doing that. Again, that is something I see that gets missed a lot as well when people are tearing down buildings. So here's something that you're going to get. I'm going to go through this really quickly. You're going to get a report like this, lots of information like this, where you've got detail after detail after detail on the building components, what the value of that is, what the class life is. The highlights here are the systems that we show for the companies or for the buildings. In terms of an estimate, you're going to contact me and say, "Hey, John, can you run an estimate for this particular property?" We'll do it. We'll come up with a land value. We got to back that out, and then we come up with a value of the property. So if you tell me, "Hey, we've got a piece of property. It's listed for $2.75 million. The land is $450,000." Okay, so we'll run numbers at $2.3 million and show you here. So here on this property, for example, this is kind of an industrial office warehouse, $2.3 million basis. We're showing down here as an initial estimate of $293,000 in increased accumulated depreciation that new owner could be able to take in 2023 if they closed on it in 2023. At a 32% tax rate, that's a $93,000 tax savings. I'm just showing you here as a ballpark for a cost of a study for something like this, $5,650. Net cost after tax is $3,800. The ROI, return on investment, is 24 to 1. That's 2,400% return on your money. Phenomenal. So these are what you're going to get from us if you get an estimate. This is page 7. What I just showed you before was page 5. This gives you a whole new depreciation table, if you will. Upper left-hand corner, you would see it's basically a spreadsheet. You're going to see, hey, we're thinking about 6% is going to be identified as a 5-year class life property. About 10% is going to be 15-year. Again, this is just an initial estimate. The numbers could be different. We tend to be very conservative in our estimates, so it's not often that we come in lower than this. But it's fairly regular that we come in higher than what we're currently estimating, and sometimes significantly higher. So anyway, so you can see what that looks like. So you would get that. Upper right-hand corner would have the price of the study. So some cost segregation examples I just want to show you here so that you have it. We'll go through kind of a variety of commercial buildings that you guys might be dealing with as you're out there. This one here is a kind of a standard 50,000 square foot office warehouse building. The cost of the building of the basis was $1.925 million. We ended up being able to accelerate. That's about 23% of the building was able to be accelerated in year 1, leaving them with 77% was the 39-year class life property that they would depreciate over the future life of the building. So huge tax savings for these owners. Here's a redevelopment project, right? A lot of this goes on, some really cool old buildings. People will go in there and they will completely gut them and then rebuild them. And on this one here, what happens is when you've got a property that has been in service before, for it, any time before, even if it was 10 years ago and it's been sitting empty, and then you bring it back to life, you're going to get what's called qualified improvement property. That's considered 15-year class life. That's a lot of the improvements to the interior of the building without the elevators or escalators, if you will. But a lot of that improvement that you're spending money on is going to get a 15-year class life instead of, say, a 39-year class life. And that gives you a huge accelerated depreciation expense. In this case, that it ended up being almost 50% of the building was able to be accelerated between the normal 5-year class life property, the 15-year class life property, which is your kind of your parking lots and land improvements, if you will, and then the qualified improvement property. This is an example retail strips. We do these all the time. These could easily be 20 to 30% of the overall cost of the building could be accelerated. So you can see in this case, this is $1.5 million. They got almost $400,000 in depreciation. Here's an example of a dentist. Could be a medical office. You know, if the ownership is the same, the operating entity as of the real estate, you can use the depreciation from the building to help offset the operating income. You need to group the property the first year that this goes into, that you file taxes on it. There's some additional things as well. Talk with your tax advisor on that. But if you can group, this is significant. You know, here in this case, the dentist was able to accelerate about 32% of the cost of the building was able to be depreciated immediately, generating a large tax savings. Starbucks, this one happened to be a 1031 exchange, so we'll look at whatever's left of the basis. So they bought this building. Total building cost is about $500,000 or so was left after the 1031 exchange. They were able to accelerate about 48 or 49% of the property, which is phenomenal because the land improvements were massive on this. As you know, they've got big driving areas, patios, sidewalks, lighting, signage, maybe fencing, etc. That can be accelerated at 15 years. Here's a Dunkin' and a Banfield, right? Kind of a fairly typical small retail strip center. They were able to accelerate about 34% of that building. So again, as you're thinking about this, if you're representing a buyer and they're buying a building that's $3.4 million, do you have any idea that maybe about a third of that could be accelerated? They might get maybe $1 million, and down here it was $1 million, $1.1 million in depreciation they were able to take in year one. And if you don't know that, you're missing the opportunity to be able to help your client to be able to understand the value proposition of that property that they're looking to buy. Here's a flex building. We do a lot of these. There's not necessarily a lot to these buildings. You know, some of them have small office space. You know, a lot of that will be considered 5-year property that'll generate some depreciation. But they also have large sites, and so lots of site improvements. In this case, that was the issue. So they're able to accelerate about 34% on this flex building. I will say that in general, these flex buildings, we tend to see somewhere between 15 and 30% is what they end up getting. Hotels are great. These will tend to be 20, 25% that they can accelerate. So if they bought the building, the cost basis is $2.8 million. They ended up with $564,000 in depreciation that they could take year one, okay, when they purchased this building. Medical offices. These are phenomenal. They tend to have a lot of 5-year property. They've got specialty plumbing, specialty electrical. Those get identified as 5 years. This one here, it's 32%. They were able to accelerate. The parking lots are also great. So the land improvements, those are 15 years. Partial asset disposition. This happened to be an O'Charlie's that was in operation, and then the lease expired for the owner, and then the following year they were starting to do renovations and converted it into a pet hospital. These are partial asset disposition studies. They are phenomenal, absolutely phenomenal. You can see down here the tax benefit for this owner, lower right-hand corner, is about $145,000 that they'll be able to save because they did partial asset disposition. These studies don't cost a lot of money. They're a little bit of an add-on to the cost segregation, and well worth it to do these studies of these kinds of improvements. So, what we deal with is, obviously making sure that we're generating a great report. We do an engineering-based study. We back up our results. So if they're ever contested by the IRS, that doesn't happen very often. I think maybe 15 times in 20 years. And that's because the building or the business owner was under audit already. And so they go through the cost segregation studies just to make sure that they are accurate. So we back all that stuff up, provide the information that's needed to defend the owner at our cost to do that on the cost segregation study. But so we're here. We've been doing this for 20 years. We are a great partner. Commercial property owners can benefit from this. Real estate investors can benefit from this. If they're buying multifamily, they can benefit from this. Triple N leases, those owners can benefit as well. So just, as you're talking to your clients, just realize you should incorporate this, consider incorporating this into your business practice. I'm going to make a quick mention of green zip tape. Green zip tape is a new technology, if you will, that when you think about when you're taping and mudding your sheetrock and your properties, and this is for big construction projects, 10 million or more, redevelopment or ground up construction could be considered to use green zip tape and participate in this. In part, the cost is high for the cost segregation and the licensing fee to do this. But you will likely see somewhere between an extra 5 to 10% of the overall cost of the project could be accelerated by using green zip tape. That's in addition to what you're already going to get from cost segregation. So it can be significant. So 5 to 10% on a $10 million project, that's an extra $500,000 to $1 million in additional depreciation on top of what you're already getting from cost segregation to use green zip tape. The reason that we get this classification with the IRS is it's a tape that is you can cut it, slice it, run it up the sheetrock. You don't damage the sheetrock. The sheetrock panels can be removed and reused, so they don't end up in the dumpster. So the IRS is given this special status. So basically everything that touches the green zip tape gets 5-year class life instead of getting a class life of 15 years or 27 and a half years or 39 years in commercial property. So phenomenal product. If you got questions about it, you're working on big projects, happy to have a conversation with you offline on that. So brokers, anywhere where you are in the U.S., I'm happy to help. Reach out to me. We'll love to chat. Again, my name is John Murphy with CSSI, 864-276-1448. Reach out to me on LinkedIn, and let's see how we can help each other and help your clients save money on their taxes with their buildings. Take care. Bye-bye.